What is going on, people? I got exciting news for everybody today. I had a little thought last night and I started thinking about it, and because I look at the option chain so much, I already know basically how they were priced, even though during the nighttime, like maybe 10 o'clock at night to maybe a couple hours before market open, all the options reset to zero, and so you can't really verify your math or check what you're doing during these hours. But I was able to come up with the idea in my head, and I was waiting for the numbers to come out, and the numbers come out, and it's everything I thought it was going to be. And so I'm going to show you how to. I'm still paper trading, but I'm going to show you this strategy that is going to blow your mind, eliminates all the risk, guarantees profits, all the good things that I've said, and it takes no skill whatsoever. You don't got to sit in front of a computer for 6 hours a day. If you do sit in front of your computer for 6 hours, and if it does move a lot, then you're going to make a lot more money than someone that didn't. But the person that didn't is still going to make what they thought they were going to make, whether they hold it for 3 days or do whatever. There is no wrong way to do it, and so I'm excited to show you how it works. And then I'll show you a couple ways to maximize the profit, and then I'm going to start doing a short live stream every day, probably every day, maybe twice a day. And in this live stream, you're going to be able to see the trades that I'm making, follow the trades, watch how they become profitable, learn how to track them in the Excel sheet. I posted an Excel sheet on the description of this video, so you can download that Excel sheet for yourself and track your own trades. But I highly, highly, highly recommend, even if you only start paper trading, copy the trades that I'm doing, watch your accounts change, and watch how you never get any risk. And after I get into my trades here and I organize it on my Excel, I will go over all the details of the trade, of why it's so great, and why I'm super excited right now. So let's check this out, people. It starts out very simple. Now, ideally, when you're getting into the market with any trade, if you're doing more than one leg, then you really want the stock market not to be moving a lot when you enter your trades. And so if you're starting a trade, I don't care what trade you're doing, but unless you're executing the option execution at the same time, so if you do like a debit spread, you can do two option legs and it'll fill them at the same time, or it won't fill them at all. But like in this situation, you're gonna execute each order separately. At least that's how I'm gonna do it until I have a computer algo that automates it, and they'll be able to do it at the exact same time all the time. But anyways, my point is that if I get into the option trade right now, because the market just opened, it's moving a lot up, a lot down, and that tends to be a very, like, the first 30 minutes tend to be very volatile, and all throughout the day you'll find points of the day where it is volatile. But ideally you'd want to get into the market when it's like just trading real slow, real sideways for a couple minutes. Obviously, if you have a computer algorithm doing it for you, shouldn't be a problem, because it can execute all four trades all within 1 second and get them all filled right away. So that's not a concern. But for now, we'll just go ahead and play with the margin of error. Some days it would work for me, some days it will work against me. So there's nothing wrong with getting in this early. It's just not exactly what I would prefer. So here's how this is gonna work. So first, I'm just gonna get into my trades, and then I'll put them in my Excel, and then we will analyze what I bought and why. Okay, so the stock price is at 27. Oh, it's bouncing so much. 27, 273.70, we'll say. Close enough. Alright. Now, for this one, this is going to be my third. I'm going to do one on the 30th to expire, and I'm going to do one on today to expire. And so I'm going to do two different examples for you. One will track over the next couple days. The other one's going to expire today. And so I'll come back and do a live stream at the close of market and see what happened. Alright, so the stock price is continuing to bounce. Now it's at 273.10. Alright, we're going to let that guy settle down. Because, I mean, that dropped 70 cents real quick. So let's do what it wants to do. Alright. Here's what I'm going to do. So 1, 2, 6. Alright, so I'm just going to come up here and we're going to do so here's what I'm going to do. I'm going to come up here. I'm going to buy 2 of these. Okay, so I'm buying 2 call options. And I'm going to buy them at 13, we'll say 13.28. Well, now it's 21. No, it's 25. We'll try 13.25. We're going to do 2 of these. Okay, preview and send. Okay, now I'm going to come down. And I'm going to sell one of these. Okay, so 277 strike, and I sold it for like 276, I believe. Why did this guy not get filled? Modify. Okay, so we're gonna do 360, 1360. Okay, so we got 1360 on this guy. Okay, now I'm going to come to the puts. I'm going to buy 2 of these guys. And we're going to do 867. Okay, 867 for the 281 strike. Okay. And then we're going to come here and we're going to sell this guy and just sell one of these. 242. And that is 269 strike at 242. Alright, so now I should have 4 option legs. So let's go make sure I got what I think I got. Let's see here. Alright, so we filled 4 of them. We got 242, we got 867, we got 1350. Okay, we got fill at, okay, there we go. So 1360. And then 271 it looks like. Or 27. Or it looks like 270. Okay. And that's a 277 call per 277 call. Okay. So now I can come to my Excel page. And stock price really doesn't matter if you can gauge what the stock price is when you made all the prices. Hopefully the stock price was relatively safe, at the same price across all 4 trades. But basically we'll go to the strike price. So in the first one we have, I did not write down the strike price. So that one is going to be 261 call. So we got 261. The ask price was 1360. That's what we got filled for. Oops. 1360. And then 2 contracts. And this equals. Perfect. Okay. Then the second leg was the puts, and that was 2 contracts. Well, the strike was 281. The ask price was 867. That was 2 contracts. Okay. Now the third leg was the call. This was the 277 strike with the 270 ask price with the 1 contract. And this is actually a credit, not a debit. So I'm going to have to change this summary page over here a little bit. That's okay. And now we got the what put was this? 269 put, it looks like. Yep, 269 put. And that was 242, 1 contract. Perfect. Alrighty, so from here, here's what's gonna happen. If it goes, so these options expire on Friday, and so if the stock market just moves totally dead sideways until Friday, basically these guys are going to expire for almost exactly what they're worth now, and these guys are going to expire and give me the credit, and the credit is $510, or it's $5.10, but with the options multiplier of 100, it's $510. And so I'll show you in a minute how we can look and see what these guys are costing us as far as they're in the money, at the money, or out of the money value. But again, like, so if this expires, if the market trades sideways all the way till Friday close, then this guy's probably going to lose maybe $1, and this guy's probably going to lose maybe 50 to 70 cents. So let's just say $1.50, $1.70. While these guys are making $5.10, basically it turns into a net profit of $300. Now, if the market moves, let's just say 1% in either direction, these guys down here are going to profit about 60%. Whichever one moves for a profit is going to profit about 60% on a 1% move. And so I'm going to go ahead and set a limit order for each of these guys to cash it out for 60% of its profit if it ever hits. And then basically if it hits the 60%, then I cash out the profit. And if it keeps running in that direction, whichever way it runs, the other side of these guys is going to make more than the other side loses. And so it will also cover the losses coming from this guy if it runs from this side. But at the same time that we cash out one of these for 60%, we're going to come in and at the new 1% change in level, we're going to sell a call and sell a put again, and basically match this but with the new strikes. And so find that these are strikes that are like 1% out of the money, and that's what we would do with these ones, 1% out of the money from the new stock price. and we would add another position to collect another $510, but from the new range. And that way, if the price moves back to where it was before, then any losses this guy had is now gone, and one of these guys are now in a profit. And even though these might show an initial loss, if they don't expire way out of the money, so cancel, like they have to move 1% to be in the money, over 1% to be in the money. And so if the market doesn't move over 1% by expiration, then I automatically get whatever these are going to pay me. And so the little volatility that goes one direction, not a big deal, because again, we have these guys who are going to make more than what these guys can ever lose, because we're doing 2 contracts instead of 1 contract, and these are starting out of the money instead of in the money. I'll explain that a little bit more in a second. But basically, I have a leg set up here. Now, I'm probably not going to stay up all day, and I'm probably not going to stay up throughout the market. Like, I've been up all night thinking about this. But I'm not going to trade it all day long. Like, if there's a lot of volatility, 1% down, 1% up, I could show you how it makes money every single day. But I don't care about that. What I care about is being able to come back and trade once a day and show you guys profits day after day after day. And so some days I might come in and I might sit here and trade it and show you how it all works. But other days I may just come in for 10 minutes, show you guys the numbers, and then step out real quick. And so we have the September one. We have the September 30th expiration completed so far. And so now the only thing that would happen is if the market moves 1%, then I would close out whichever side's profitable here, and then I would execute these guys right here. And so now I'm going to go in and I'm going to buy the same thing, but for today's expiration, and not the exact same thing, because the closer it is to expire, the slightly different you can work the strikes. And so we're at 274 right now. And so what I'm going to do is I'm going to come in and let's just buy this guy right here. So I'm going to buy 2 calls here for 10.07. Or we'll just say 10 even. I guess we gotta go to 10.07. Oh, there we go. Okay, we got 10 even on the 264 strike. Okay, then I'm gonna come down here. I'm gonna sell this 277. I'll probably sell the 276 for $1.15. So we'll come here, we'll do $1.13, and we're just gonna do 1 contract, and that is what strike? 276. Call. We did $1.13. Perfect. Now I gotta do the puts, and so on the puts, I'm gonna come here. I'm gonna do the 537. And this, I am only knowing, like, I can show you guys how to do the math later, but I know, like, I was already looking at the numbers, and I know which numbers look good. So we're doing 533, that's not going to work. We'll do 543. Okay, so this is going to be 279 puts at 543, and then I gotta come in and sell a put. I'm gonna come in here and I'm gonna sell this guy right here at $1.12, and just 1 contract. Looks like it was $1.13. So 272 put. doesn't look like it sold. Why not? Okay, it went down. That's okay. We'll take what it gives us right now, so it's 105. Okay, I just want to fill. I don't care about this. Tell me you filled. Let's go already. Oh, it went way down. That's what happened. Okay. Again, I do not really care about the pennies right now. Just trying to do an example. There we go. Alright, filled at 89 cents. Okay, so now I can come back to my Excel. If you guys see at the bottom, I'm going to have to switch this up. So, rename. This is the one with the 30th expiration. Oops, that's not going to work because I already have one that says that. Okay, so rename to 28. Rename to 30. Alrighty. So for every time I trade a new expiration, I'm going to create a new one of these sheets, and that's why I always keep a blank copy, so I can always just copy and paste a new page. But basically, let's fill in the details here. So I bought first leg in the money. Okay. It's a 264 strike. Ask price was $10 even. Number of contracts 2. And then this one is the put, which was 279 put. Ask price was $543. Number of contracts 2. Okay, then the call was a 276 call, and we actually sold it for $1.13, one contract. And then the put was a 272 put, sold it for 89 cents, one contract. Okay. Alright, David says, hey Marcus, SOB knocked me out of your Discord over a joke about $4 being the Mullen squeeze. Still holding for market crash. How about letting back in the Discord? The only Discord that I have anymore for anybody is a Discord for people that joined the lawsuit. The other Discord has been silenced. So if you haven't joined the lawsuit, then don't even fucking talk to me. Let's see here. Alrighty. So now if we go to account, we go to positions. Here we are. And we have these 4 for this expiration. And we have a buy, and then a sell and a sell. The sells are all 1 contracts, the buys are 2 contracts. We bought 2 contracts of calls in the money, 2 contracts of puts in the money, and then we sold 1 put and 1 call out of the money and we did that for both expirations. Now let's go and try to visualize what I just done here. So it's all done now. I don't need to do anything else. But let's try to visualize it and see what happens. Alrighty, so if I come here, I want to see something that would be $10.24 in the money. probably wanted to come up here, because that would be $15.24. So I probably didn't buy quite as in the money as I wanted to. What did I do? I did 1360. Probably not that bad then. Alright, so we'll just assume the closest number, it would be about right here. So I'm buying here. I'm doing 2 contracts. Then I'm selling here. And I sold at 270, it appears. So we'll say right here. And then for the puts, did at 281 for 867. So we basically bought here. And then we basically sold at the 269 for 242. But this is 230, so we'll do the 230 to be a little bit more conservative. Calculate. Alrighty, let's see what we got here. We'll do 250 to 275. Alrighty. Oh, we gotta go way higher than 275. We'll do 300. Alrighty. Here we go. So, this is what it looks like. Now, it's saying I can lose as much as $682 here. I was doing the math already, and I can assure you that the loss, if any, is negligible. But like if you look right here, if it moves in the first day or the second day or the third day, we actually make money here on certain sides of our legs. And so when we cash those profits out, ultimately you're giving yourself the best opportunity to always be profitable. And so let me just think about how to put this into words for a second. So in this example, it's saying that I am, like if we just look right here, so I'm buying an option for 2,800 here. I'm buying an option for 1,800 here, so it's $3,600 I'm putting in. But because of my 2 credits right here of 230 and 262, that's $490, and so roughly $500. And so my net trade is my entry cost starts at the 4,600, 1,800 plus 2,800, so that's 4,600 minus the 262, and so minus the 500, and basically it gives us an entry cost of 4,132. And that's just basically what you put on the calls and the puts, what you bought long on each side. Now, here's some of the math that I want you to look at. So if we come here, what I want you to see is, and it's easier to see on the 30th. Okay, so if we go to the 270, if we go to the 274 strike, which is basically at the money, it's $4.39. The intrinsic value of this is only 18 cents right now. So this 439 is only based on the 26 cents above the 274 that we are. The rest of it is extrinsic value. Well, so this 274 strike has $4 of extrinsic value. Well, if I come down all the way to here and I look at this 261, this guy is $13 of intrinsic value. And so that means it only has 80 cents of extrinsic value. And so what happens is if I go up $3, so if we go from 261 and we go to 260, 259, 258, I go from 1372 to 1644, 1637. So I'm basically getting $2.70. If it moves up $3, I get almost all of the $3. Where if we look at this put right here that I bought for the 823, well, if it goes down $3, 1, 2, 3, I'm at 629. 825 to 629, so I've only lost $2 while I gained $3 on the other side. If you do that again, 1, 2, 3, you go from 615 to 460. Now you've only lost $1.50, where I know that the call would have gained another $2.50 to $3 of intrinsic value. And so what's happening is, because after you get so deep into the money, you lose all your extrinsic value. Well, when you buy these in the money options that have basically no extrinsic value, when they lose money and become at the money or have $1 or $2 in the money, they still have a lot of extrinsic value. So the money you're gaining on the other side is going to outweigh what you're losing on this side. And it works both ways on the calls and the puts. And so you're hedging yourself there. But then on top of that, I have my calls that I'm selling. Now, because I'm gaining more money than I lose on the call or the put side, like that profit is just gravy on top of what we're about to look on the sell side. So the first thing that we want to look at on the sell side is that because we have two contracts versus one contract that we're selling, well, with this one contract that I'm selling, with the one contract that I'm selling, like if it was just a skyrocket in one direction of the price, I would make money because the two contracts is going to gain more than the one contract can possibly lose. And the two contracts is starting in the money, where the one contract is a full percent out of the money. And so it's got to move all the way to in the money. And then on top of that, whatever the credit was that I sold it for me to start losing on that deal. But by the time it hits that point, I've already made more on my call on my buy option than I lost on the other option I bought, and it's going to cover any loss that I could potentially lose on my sell side, and it works for both sides. Oh, I hope that makes sense to you. Like, the more I think about this, the better I'll be able to explain it in a little bit. But right now, I'm just going to come back on every once in a while and show you guys how it works, and just keep flipping that money. And so here's the thing, guys. This is a debit spread. So like normally you need a portfolio margin account in order to to get credits and do a lot of credit trading. Especially if you're gonna do like a naked open or a naked short on selling a call option or selling a put. But because we're buying more than we're selling, and because our strikes are more in the money than the ones that we're selling, it becomes nothing more than a debit spread. And like you can have like the smallest account, like the weakest trading account possible, and I think you're still allowed to do debit spreads. And so a debit spread in itself has has very defined risk, is what I should say. And I am excited to let this play out for a couple days and show you guys how what it produces. Yeah, I don't know. If there's any questions, I could answer them, but other than that, like, I'm freaking stoked right now. And so, if I'm trading this properly, then what I would do is I'd say, okay, I came in and I bought, let's see here, I bought these 272 puts for September 28th for 89 cents, or I sold them for 89 cents. So if I do 0.89 and times that by 0.4, because I want to collect the 60%, that means if my 89 cents, so if these guys hit 0.35, then basically I will collect 54 cents on my, so I'll collect $54 on the $89 that I sold. So I'm going to go ahead and hit that. Now, if this does fill, I would want an alert on my phone to tell me so that I could come and set a buy order to sell another, or not set a buy order, but reset that credit spread. Because like if one of these closed, then I want the other one to. If one of these close for a 60% profit, then I want to start the new legs for another sell put, sell call. Now this one I did $1.13. So that means I want to buy it back at 45 cents. And that would mean I collect $68 on this trade if it closes. And then for the September 30th ones, I did for the 277, I did 270 was the $2.70 was the amount, so I'll do times that by 0.4. I want to buy it for $1.08. Which means I'd make roughly $160. And then the 269 put, I did 242. So I'm just doing $2.42. I'm multiplying that by 40.4, so 40%. And it tells me that if 40% of the value of the 242 that I sold it for would be 96 cents. And so basically by selling at 242 and buying at 96 cents, I pocket $135. And so now I just leave it like that, and I can come back tomorrow, and I could come back at the end of the day. I could come back whenever I want. Like we'll see what each trade does, but I'm nearly certain there is no risk. I'm so certain. And again, the market was moving a lot when I got in, and so like there could be that kind of delay, that lag, that like I bought this call at the most expensive, the put at the most expensive. I sold for the least amount on both the call and the put. And if that was like the perfect scenario, I could have like lost all the profits through there, but it's still gonna break even, so it doesn't really matter. But that's all margin of error bullcrap that like sometimes it'll work against you, sometimes it'll work for you. So some days would be just more profitable than others. And then on top of that, once we get this automated through an algo, the execution will be instantaneous, and you won't have to worry about the slippage. And then on top of that, you will be able to identify which ones to buy, which ones to sell through the algo going through and analyzing what the best combination is. What else? What else? What else? Yeah, so on Twitter I tweeted that I found the arbitrage. And basically, there's an arbitrage to be found between at the money options, in the money options. So, like, the fact that you go from at the money to having a huge amount of theta and extrinsic value to going in the money and losing all of that, well, being able to play both sides, you're guaranteed if one side loses, then the other side wins. And when one side loses because it's starting to gain extrinsic value, the other side winning is gaining all of the intrinsic value when it's moving in the right direction and only going further in the money. Like, it's just, I don't know, it's a perfect storm. Again, I'll find better ways to explain this to you guys. But right now, I just want to hopefully put that information out there for those who know what they're doing and can make sense of what I'm saying. This is something that, this is something you jump all in on, people. If you know what I'm saying and you know what I'm doing right here, there's absolutely no reason not to freaking load the boat, because if you look at the stock market that we've had, all the 1% movers, not only are we not risking anything and we break even throughout any situation, but every time it moves 1% one direction, 1% back the direction, we're collecting profits. We're collecting profits every single time. And we'll have to see what works best as far as net ROI, whether it's a 3-day to expire option and using the theta levels there, or whether it's trying to hit the 1-day to expire options. Whichever one pays the highest daily ROI is obviously what we want to do. But if they're all profitable, then it doesn't really matter. And we can always make things better and fine tune it as we go. I'm super excited about this. Nobody's ever done anything like this. This is brand new to the world. And somehow it just hit me last night. Just a small idea hit me in the head, and I followed it down to its depths, and I found good news. The rabbit hole didn't leave me guessing this time. It's just simple math that makes simple logic that makes super safe returns. Oh, it's unbelievable. It's perfect. So I want to see what's happening here. Why at 280.50 do we lose money, it says. saying the calls that we bought made a profit and closed up 4,100. The call that we sold lost 350. But is that counting my credit? 277, and this is 280.50. That does not look like it's counting my credit. I guess it's counting the credit in the beginning. So this is where the credit is counted. And it's saying my 268 puts expired 50 cents in the money for $100 for a net loss of $282. Where on the days that I win, it's saying I would close for $68. So let's see what we got here. So at the 1404 and the 260 call, so I mean, if this 273 was accurate when we bought this, then that would mean my intrinsic value was $13.20. Well, the intrinsic value is $13.24, making my extrinsic value 80 cents. Okay. Here's $262 credit. And then this guy right here. So if it's a 281 put and the price is at 273.24, then that would mean I have $7.75 of $7.75 of intrinsic value, and the price per option was $9, so that's $1.25 plus the 80 is $2. So that leaves, if we subtract the $2 from the 262 credit, that's 60-cent credit plus the 230 credit should leave a 290 credit. And so this guy should be closing in at 290. If we just expired at the 273.25, we should be getting $290 here. Why are you telling me something different? We've got 1450 and 650 is what that's saying. So the 1450 made 50 cents profit, but the 650 is saying it lost $2.50, so that would be a $2 net, which still leaves me with the $2.90. Okay, so that's $4,624. $46.24 before the credits. And so the biggest mistake looking here is this 908, because the put should have less extrinsic value when I buy it in the money than the call. And I don't know exactly how that worked out when I've actually bought it in for real, rather than using that stupid chart. but let's take a look at this. So it says for today's expiration, my calls are in a profit, my puts are down, and both the ones that I sold are in a profit. So it's saying I made $14 here, $15, so $105 versus losing $79. But that bounces around a lot, you see. And then on the next legs, making 117 here, 39 here, and losing 20, and losing 144. So it does look like I've probably gotten a slightly bad trade just with the movement of the market when I bought my options, but it's not going to stop me from making a profit. It's not at all going to stop me from making a profit. Well, the reason I want to trade these expirations, so if I'm trading 3 days to expiration and I can pull a 10% profit off like my entire account balance, that's averaging 3% of profit a day. Where if I can go and I can find a month to expiration and I can make, let's say 20% profit, 30% profit, well, 30% profit by 30 days is 1% profit a day. And so it's really just about finding whichever days to expiration versus the theta is going to pay the greatest daily ROI. But if there's no risk on the short side, if there's no risk on the short side of early expiration and you're able to profit in a day or 2 days or 3 days, then I would assume that that's where the most profit is going to be found. And because there's options to expire on the QQQ Monday, Wednesdays, and Fridays every week, it will be a very repeatable process. Now, with the way that we're trading here, you don't actually need a day trading account. This is all something that you should be able to trade without a day trading account. You may need to upgrade your account to where you're not limited by the number of trades that you can make, but you won't be restricted by the $30,000 minimum account balance. And so you may, like I said, you have to have a day trading account, but you don't have to have the $25,000 minimum account balance that allows you to intraday trade your cash balance. So basically, like with my account right now, if I buy something, I can sell it, but now I can't use that money to buy something again until the next day after I've sold it. And so this strategy in that situation would still be able to make you money. Obviously, we'll see in the next week of me trading this how much it profits, and we can just do a little calculator, but if it profits, let's just say 10% a day, or not 10% a day, but we'll say 10%, we'll say 25% a week. If we're doing 25% a week, we'll say 20% a week. Now, you don't need the minimum $30,000 account balance to do this, but because we're buying in the money options, they are more expensive, and so you probably do need close to, how much did I spend here? You probably need close to $5,000 in order to do this properly. $5,000 will get you started to where you can afford to buy the calls and the puts, and then when you can come in and sell for your credits. But if you have $5,000 and you're making 20% a week, 1 week, 2 weeks, 3 weeks, 4 weeks, it would take you 4 weeks to double your money. So you go from 5,000 to 10,000 in 4 weeks, 10,000 to 20,000 in 4 weeks, 20,000 to 40,000 in 4 weeks, 40,000 to 80,000 in 4 weeks. And I'm pretty confident 20% a week will be no problem. It's possible it might only be 10% a week, but we'll see. Yes, E-Trade offers that type of account. E-Trade offers it. I would think I like E-Trade the best. They got the best customer service line. I used to call their customer service 100 times a month. They're 24/7. They're always there, and they will find the answer for you if they don't have it on them right away. I'm tired. I mean, 10% a week's the greatest thing anyone's ever done, ever. Ain't nobody ever even dared say they could do 10% a week. And this, from everything that I can tell, everything I can see, guarantees 10% a week. Like on the good weeks where we get the volatility of 1% movements multiple times in a day, like I'm making 10% that day. Alright, guys. Well, I will be back probably at close to give an update on how the account looks. Yeah, I just recommend if you don't understand what I've gone over, go back and rewatch the video, and then rewatch it again, and then rewatch it again. Think of some questions to ask me if you don't understand something. But, like, this is the real deal, people. This is game over. This is me shutting down the stock market, saying no more. This is me laying down the law, saying I am the smartest man on earth, the only man who is able to crack the stock market. Right here, that's what this is. We don't got to worry about all that day trading crap that I was talking about with my last strategy. Even though my last strategy is great and awesome and better than what anyone else is doing, this is the thing where anyone can do it. It was just 8 simple trades, and now all I got to do is wait to make a profit. And you don't even have to be there to like do these orders. Like, you can just come back the day of expiration and you'll be fine, regardless what the stock does. But in order to maximize profits, you put these limit orders in, and you would ideally watch the stock market the whole day. Alright, guys, enjoy your day.